Hi, in this video, we'll break down the federal income tax formula. Before we dive in, remember, this is the big picture of how federal income tax is calculated, not every exception or special situation. The goal is to understand the flow, from your gross income all the way down to your refund or tax due. Once you see the structure, all the line items and rules start to make sense. Most deductions and credits have income limits or phase-outs based on your age, filing status, and adjusted gross income, AGI, or modified adjusted gross income, MAGI, meaning your eligibility or benefit amount can shrink as your income rises. AGI is your total income minus certain above-the-line deductions like IRA contributions, HSA contributions, or student loan interest. It's the key number that determines what deductions, credits, and tax brackets apply to you. MAGI is your AGI plus certain add-backs, such as tax-exempt interest or foreign income exclusions. Think of MAGI as the IRS's way of measuring your true total income when deciding whether you qualify for specific tax benefits like IRA deductions, education credits, or health insurance subsidies. AGI is the base layer of your tax return. MAGI is the IRS's customized version of your income used for specific tax benefits. Most tax software can automatically determine your eligibility for deductions and credits based on your AGI or your MAGI. However, doing it manually even once helps you understand how the system actually works, making you far better at spotting opportunities or mistakes later. You might have heard of above-the-line versus below-the-line deductions. Think of the line as your AGI, the most important number on your tax return. Above-the-line deductions are adjustments you can take before AGI is calculated. They reduce your income, whether you itemized or not. Examples: IRA contributions, health savings account, student loan interest, self-employed health insurance. Below-the-line deductions come after your AGI. At this stage, you choose one of two options. Either take the standard deductions, a fixed amount based on your filing status, or itemize your actual deductible expenses, whichever gives you the bigger tax benefit. You simply compare the two, take the higher amount, and subtract it from your AGI to get your taxable income. Examples for itemizing includes mortgage interest, state and local taxes, charitable donations. Before we go over every step of the formula, let's first talk about tax deductions versus tax credits. A tax deduction, also called a write-off, reduces the income you're taxed on. For example, a $1,000 deduction might save you about $220 if you're in the 22% bracket. It's like reducing the pie the IRS gets to slice. A tax credit reduces your tax bill dollar for dollar. A $1,000 credit saves you exactly $1,000 in taxes, much more powerful than a tax deduction. It's like erasing part of your tax bill entirely. Now let's break down the full federal income tax formula step by step. Step 1. Gross income. This is all legally taxable income before deductions. Includes wages, salaries, tips, W-2, business or freelance income, Schedule C, rental income, Schedule E, interest, dividends, capital gains, and taxable Social Security, unemployment, pensions, or gambling winnings. The result is gross income. Step 2. Subtract adjustments to income, also called above-the-line deductions. Common examples: IRA contributions, student loan interest, HSA contributions, educator expenses, half of self-employment tax, SEP, simple, solo, 401k contributions, alimony paid, pre-2019 divorces, and self-employed health insurance. The result of Step 2 is your AGI. Step 3. Subtract standard or itemized deductions, Schedule A. Choose the higher of the standard deduction or the itemized deduction. Here's a quick overview of the standard deduction and itemized deduction for 2025. If you're self-employed or own a small business, you might also qualify for the Qualified Business Income Deduction, QBI, which lets you deduct up to 20% of your business income. The result of this is your taxable income. Step 4 is compute gross tax liability, which gives you your taxable income. Multiply your taxable income by the appropriate IRS tax rate to calculate your base tax. Apply the current tax brackets, 10%, 12%, 22, 24, 32, 35, 37, whichever bracket you're in. Special calculations apply for certain types of income, like long-term capital gains, qualified dividends at 0%, 15%, or 20%. Alternative minimum tax, ATM, may apply in specific cases. Result of this is your tax before credits. Step 5. Subtract tax credits. Credits reduce your tax dollar for dollar. Non-refundable credits can't reduce tax below zero, but refundable ones can. Here's the list of some common tax credits. Step 6. Add other taxes. Some taxpayers owe additional taxes, like self-employment tax, household employment tax, early retirement withdrawal penalties, AMT, or net investment income tax. The result of this is the total tax liability. Step 7. Subtract payments and withholding. Federal income tax withheld, like W-2s, 1099s, estimated tax payments, and refundable credits, such as the Earned Income Tax Credit, Additional Child Tax Credit, refundable part of American Opportunity Tax Credit. The final result is tax due or refund. Here's another way to look at the formula. This version shows the core math behind the tax system, but skips step 7, which deals with payments and withholding. This version stops at your tax due before you compare it to how much you already paid through W-2 withholding or estimated payments. Once you factor those in, that's when you find out whether you owe or get a refund. Here's a summary formula for all of this. Refund or amount due equals the payments plus refundable credits minus total tax minus non-refundable credits. So if the left side, payments plus refundable credits, is greater, you get a refund. If it's smaller, you owe tax. Understanding taxes isn't about memorizing every form or exception. It's about seeing the logic behind the system. Every tax return, no matter how complex, follows the same flow. Income, adjustments, deductions, credits, payments, refund, or balance due. Once you master that framework, everything else becomes easier to interpret. From knowing which deductions apply to spotting where your refund really comes from. Think of this formula as your roadmap through the 1040. You can always add the details later, but start with the big picture first. Thanks for watching. We'll see you in the next video.